From New York City for our viewers worldwide, I'm Scarlett Fu. Bloomberg Real Yield starts right now. Coming up, hotter than expected inflation triggering a global bond sell-off. The 30-year yield now at the highest since 2007. As Kevin Warsh gets ready to assume the title of Federal Reserve Chair. And a New York budget battle. Reportedly, there are plans for a new tax on some six-figure homes in the city. We begin with the big issue, a challenging path for the Federal Reserve.
The incoming data in the U.S. has been more resilient.
But that doesn't mean there's not tensions.
We're beginning to see some weakness creeping in.
That what we're seeing with the U.S. economy right now is a narrow foundation to growth.
The wages are no longer keeping up with prices.
That longevity of the inflation, that probably starts to affect the psychology of consumers.
Treasuries won't do the job if we get inflation volatility.
Bond yields definitely feel like they're getting a bit unhinged.
The brunt of the pain has not yet been felt.
We're tracking above on core PCE and a little bit below on unemployment. So it's a difficult case.
The case for a rate cut here gets tougher and tougher.
There's a greater probability priced in of a hike rather than a cut.
We don't expect interest rates to come down.
We'll see one more cut this year.
We start to see some rate cuts in the first part of 2027.
This is all against a backdrop of rising rates, especially this week. The 10-year yield has climbed higher every single day this week. On Wednesday, it touched 4.5%. That is this red horizontal line. That is the highest since going back to last May. And it has continued to move higher as the week progressed. Today, it's up 10 basis points, reaching 4.58%. Now, further out the curve, we see the 30-year yield rounding off its biggest weekly increase since 2025, up 18.5 basis points in these past 5 days. And it's not just the U.S. We see long-dated bonds struggling around the world, and that is sending yields to multi-year highs in Japan, in the UK. And all of this as Kevin Warsh prepares to assume the top post at the U.S. Central Bank. Outgoing Fed Governor Stephen Miron believes that the outgoing Fed Chair Jay Powell can actually help smooth the transition.
Transitions are important, and I think that, it is maybe helpful to have someone there to give advice, but I still think it's important that it be a transition because you want to have people's loyalties undivided. You want to have there be very clearly one chairman. You want to have a place where there's no question about who's in charge, and there's no talk of rival factions and things being split.
Our international economics and policy correspondent Michael McKee joins us now with more, and he's got a chart in hand. Mike.
Well, it is very easy, Scarlett, to see the problems that we're going to face, or at least that Kevin Warsh is going to face going forward. He's got Donald Trump's threats of trying to fire Fed officials and get interest rates down as basically hanging over his head as the sword of Damocles. But this chart shows you the problem very simply. You can see the blue line at the top there. Basically, that's unemployment. It's steady. Doesn't show any reason to cut rates. But the other two lines are the CPI and PPI reports we got this week, and you can see they are moving in drastically the wrong direction from the Fed's 2% target. So there's not going to be any way to cut interest rates in the short run. Now, the question is, does that make a big difference to the economy? No, it probably helps that they just sit there for the time being until they get a better read on how long we're going to have this war-driven inflation. But how's he going to handle the president? That's going to be an issue, and we're going to be interested to see whether or not the president has enough patience to let him get through a couple of meetings. He has meetings on June 17th and July 29th. Maybe by the time we get to September 9th, which is the meeting after that, they'll be able to at least talk about it.
All right, so a lot on the to-do list of the incoming Fed Chair, Kevin Warsh. Our Michael McKee, thank you so much for setting that up. And of course, we will speak with you again later this hour. I want to bring in now our roundtable to talk macro. Ed Al-Hussainy at Columbia Threadneedle Investments and Herr of JPMorgan Asset Management. Guys, thank you so much for joining us today. There's so many different places we can start, but I think we've got to start with the action that we're seeing in global bonds today. How would you characterize the rise that we've seen in global bond yields this week? It was fairly steady before really picking up momentum today. Ed, I'll start with you.
Yeah, absolutely. I mean, I think we're tripping some big numbers in terms of the level of these yields. And I think we're starting to see portfolios reposition really kind of based on two factors. One, risk assets continue to do really well. So if you were under risked, you're catching up. and fixed income is starting to drag. And so we're seeing that repositioning show up, particularly in longer term yields at the moment.
So that's an interesting point. I might have made that point yesterday. When you looked through yesterday, you had S&P 500 up 9% and bond yields kind of flat. And there's been this disconnect that the S&P 500 U.S. equities keep marching higher, and there's this disconnect in the bond market, a little bit more worried about inflation, a little bit more worried about term premium, and the equity market continuing apace. It feels like things have shifted a bit today, and equities losing a bit of a bid. And it seems like you're more appropriately attired in red today than I am in green, Scarlett. Maybe I'm just optimistic here.
Yeah, and it's across equities, it's across bonds, so across all different asset classes.
That's right.
You could argue, given what we're seeing in the UK and Japan, that the tail is wagging the dog. The dislocations that we're seeing overseas spreading to the U.S. today, intensifying the sell-off. With JGB yields surging, Kay, is global fixed income losing its anchor?
So, gosh, it does feel like the bond vigilantes are back. And so I wouldn't say that we're losing the anchor, but I would say that global term premium is back in focus. And that's exactly right. We'd had a little bit of a modest sell-off, as you noted and Mike noted. Rates are really back to where they were a year ago. This is not that excessive of a move. We're back to where we were when we had concerns about tariffs on Liberation Day. But what's really happened overnight and into today is real concerns about the UK, about global term premium, et cetera. And I think if you look at the move we've had this morning, it's been more real yield driven, not inflation. Prior to today, the concern has been about the inflation on CPI, PPI. Today, of course, we've got crude, gas prices up a little bit higher, but we're not seeing that flow through into inflation expectations. It's more of a global term premium, which one could make an argument here that the U.S. doesn't have to be dragged up to that level.
So I wonder, now that we're seeing the not panic, but the concern seep into equities. We have equities lower today, retreating from record highs, but still the direction is down. Ed, are we seeing a repricing of the entire real interest rate environment?
A little bit. I think the picture that's coming into focus for me is one in which monetary policy in the front end is a little bit too relaxed. And therefore, you're starting to see that bleed into high real rates across the curve. You're starting to see that bleed into a little bit more inflation compensation further out. That's much more pronounced in places like Europe and the UK for obvious reasons. But the whole complex is lifting higher, in part because central banks haven't really acted. They've created a permission structure for higher rates. They haven't really acted on them yet. And I think we'll see that change in the course of the summer.
Yeah, the betting right now is for higher rates. Traders in the U.S. now see 2/3 odds the Fed will hike in December. In Japan, they see the BOJ resuming interest rate increases in June. And of course, in the U.K., they see the big Bank of England hiking rather than cutting. Having said all of this, where do you want to be on the curve, Ed?
I think the long part of the curve is getting a lot more attractive. So if you're an income-oriented investor, you're looking around, you want to hedge some of that equity risk, you want to hedge some of the credit risk, and both of those asset classes have done extraordinarily well. The long part of the curve is looking much more interesting, particularly in an environment where central banks are going to tighten policy in the front end.
Okay.
I'd be more interested in the belly of the curve. And I'm not going to sit here and argue in favor of cuts because I don't see those in the horizon. But I think the picture is more mixed. And I think we are, of course, talking about the future, which is quite uncertain. And I think there's a lot of data that will come in that will reveal it. So far, we've had two things. The first is the reason that the equity market has been so resilient, and credit as well, is because of the underlying strength. We came through, first quarter earnings season has really been stronger than anything we've seen. We've got EBITDA, strong EBITDA growth. We've got margins at 20-year highs. EBITDA growth higher than it's been in 10 years. So you've got an overall fundamental picture that's really quite robust, and that's what's been holding up equity prices. On the other hand, you've had this inflation picture, and I don't know when the last time you got gas. It was $4.45 or something like that for me. What the data shows, and it was interesting this week, that retail sales were still stronger than expected and evidenced resilience. What we've seen previously in prior cycles is when gas is at $4.50 in the range that it's in now, typically consumers go for substitution. And if I look at our underlying Chase data, what we've seen has been interesting. You see the price in gas prices, but consumer spending on gas has not tracked it as much. So you're having some substitution.
Yeah.
Maybe people are working from home. We're not. But maybe people are carpooling, whatever they're doing. You're not seeing that. When what we find is when gasoline is back up to $5, then you start to see more of demand destruction. So I think what's really going to unfold, and the picture's not clear on this, is how does the consumer behave? And my honest answer is, I'm not sure.
Yeah, well, we'll get a glimpse of that when the retailers start reporting earnings in the coming days.
Next week. That's exactly right.
So it'll be very interesting, and certainly the companies that sell to the masses will give us a really good read. When it comes to the risks facing the U.S. economy, Michael Barr, the Fed governor, has said inflation is the overwhelming risk facing the U.S. economy. And according to Bank of America, Ed, U.S. inflation is on course to exceed 5% by the November midterms, unless the monthly gains that we've seen, the 0.4% gains that we've seen, start to slow down dramatically. What gives you confidence that perhaps we can get there?
I think the question for policymakers is the next 6 months, in some ways, is a lot of inflation momentum baked into the cake. The question is, will inflation start to normalize by the time we get over the hump, by the time we get to next year? Or is there underlying heat in the economy? Is this economy heating up to the extent that labor markets are a little bit more stable, to the extent that there is demand being brought forward on the investment front, and that's going to keep inflation momentum going? Right now, I think the trajectory has changed slightly versus last year. Last year, we were concerned about downside labor market issues. Now that picture is a lot more stable. It just points to the fact that policy, particularly in the front end, has to get a little bit tighter to control that inflation further out. But this November, yeah, I mean, I don't think you can do much about that.
No, it's coming up pretty quickly. Michael Barr also pushed back against Kevin Warsh's proposals to shrink the Fed's balance sheet. Barr, of course, speaking from the point of view of wanting to promote a sound banking system. I guess I'm just wondering, what problems is Kevin Warsh trying to solve by shrinking the Fed's balance sheet?
That's an extraordinarily difficult question. Historically, the argument has been, let's shrink the Fed's balance sheet when times are good so we can grow it again in periods of distress. That's very much a political permission structure argument. When you go to Congress, you want to make sure that you get that permission.
So it's dry powder, basically.
Dry powder in an emergency. The biggest issue is you are introducing new risks into the financial system by drawing down the balance sheet. This environment of excess reserves, this environment of excess liquidity in the banking system feels okay today. We could quickly change, and then you're in an environment where you need to grow it again.
All right, good stuff. Thank you so much to our macro roundtable, Ed Al-Hussainy of Columbia Threadneedle and Herr of JPMorgan Asset Management. Still ahead, after a slow start, JPMorgan's private credit push is finally taking off. $2 billion in loans traded this year, despite some concerns in the market. This is Real Yield on Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. Of interest to us this week, with the ongoing turmoil taking place in private credit, Franklin Templeton CEO Jenny Johnson says the industry should not be trying to convince investors that assets are liquid.
So to me, it's all about matching the right vehicles with the needs, because these are illiquid. It drives me nuts when I hear people acting like, oh, no, private credit's more liquid than you think. It's not. But it can be put in vehicles as a percentage of a vehicle that keeps the vehicle very liquid. And so I think that that's very important. And honestly, I think the best place for this is in retirement accounts.
Meanwhile, private credit is still showing signs of growth. JPMorgan's push into this market is starting to build momentum after years of sluggishness. The firm's global heads of credit trading and credit financing say the bank has traded roughly $2 billion of private credit loans this year, more than in all previous years combined. Catherine Giglensy is a finance editor for Bloomberg, and she joins us now with more. So, Catherine, why has trading of private credit started to pick up in recent weeks?
Well, it's interesting because they've been pushing this initiative for a while to have sort of this secondaries market for private credit, but it's really taken off this year. And I think that really just underscores the stress in the market that we saw. You know, investors were trying at the beginning of this year to get a much better sense on valuations and exposures to sectors that might be hit by, the rise in AI and software. And so I think a lot of this is just driven by sort of the volatile market we've had for private credit this year.
And how does their $2 billion of trading compare with peers? I mean, where does that put them?
Yeah, it's not a huge amount, even by JPMorgan's own standards. Like in the broadly syndicated loan market, they're doing about $1 billion a day. So like this is small for them right now. I think they are very optimistic, though, that this might increase. And I think that is partially driven by this desire from investors to have a little more transparency. Obviously, private credit is never going to be quite as transparent as public credit. But I do think, there's been this push of like, we have to be a little more up there with valuations and sort of forthcoming with how these assets are faring. And I think, their optimism probably is founded.
What have we seen in terms of pricing then?
Well, this is interesting because I do think, there have been all these concerns about private credit. How is it faring? Is it going to actually hold up? And JPMorgan was telling us that they've seen most of these trade at 90 cents on the dollar. So I think that really reassures people that, even though there has been a lot of turmoil and a lot of sort of stress in this market, it really hasn't yet affected a lot of the pricing that at least we're seeing so far.
All right, thank you so much. Catherine Chiglenski giving us a glimpse into what's been going on with JPMorgan's private credit ambitions. It's a part of the industry, the part of the market that it's really been working on to try to build out. Still ahead, we've got global return. Venezuela kickstarting a multi-billion-dollar debt restructuring process. We're going to have all the details on that coming up next. This is Bloomberg Real Yield in New York.
I'm Norma Melinda. Let's take a look at your midday movers. First up, a sell-off in global bonds gaining momentum, with the 10-year Treasury yield jumping 10 basis points to 4.58%, the highest level in nearly a year. Investors are increasingly concerned that central banks will be forced to keep policy tighter for longer, amid higher oil prices sparked by the U.S.-Iran war. That sell-off in bonds helping to halt a rally in stocks. Investors are ditching riskier assets after a series of hot inflation prints this week. Even with today's pressure, the S&P 500 is on track for its 7th straight week of gains, which would mark its longest winning streak since 2023. Semiconductor stocks are leading today's market decline, with momentum sharply reversing for a second time this week. Shares of Micron and Intel and Nvidia are all lower as investors rotate out of some of this year's biggest winners amid rising rate concerns. And finally, on the flip side, Figma shares are surging by double-digit gains after the company issued a stronger than expected revenue outlook for the current quarter. The company pointing to early success monetizing AI tools by charging users directly for new features. Those are your midday movers. I'm Nora Melinda.
All right, let's now step outside the U.S. for our global return look. Venezuela is preparing to launch one of the world's largest ever debt restructurings as it aims to rework billions of dollars of defaulted bonds and loans. Bloomberg News emerging markets reporter Maria Elena Vizcaíno joins us now. And Maria Elena, how did the market react to Venezuela's announcement that it will start restructuring $170 billion of these defaulted bonds and loans?
Right, so the government announced that they had hired a sovereign debt restructuring advisory firm to commence the progress, and it sort of took investors by surprise. They were expecting this to drag out for a lot longer. It was only last week that the U.S. Treasury allowed the government to hire someone. So the bonds, the benchmark 2027 bonds rallied about 1 to 2 cents on the dollar. But if you really want to look at this whole thing, you have to go back to January. This is just one piece of the puzzle, for the excitement that has been building up over the last 5 months, right? Those same bonds in total have rallied 23 cents on the dollar.
Okay, so that's pretty notable here. And I guess what's taken people by surprise is how quickly things have progressed. So having said that, how soon can a restructuring get done?
Yeah, I don't think anybody knows. The licenses that the U.S. issued only allow the government to hire advisors, not to actually restructure, transfer, or sell new securities. So technically, a restructuring is still illegal. So we're on the U.S. government timeline for this.
Oh, interesting. So what did the advisors then do? They're just kind of thinking big thoughts at the moment?
Yeah, possibly. You know, there's a lot to do in Venezuela, which has been defaulted since 2017. So the IMF has to come in and do a debt sustainability assessment, which is sort of the master document that, you know, all kinds of creditors go off to determine how much each one of them is going to get paid. There's other things complicating this situation, which is that because Venezuela has been in default for so long, there are a lot of judgments from U.S. courts over the nation's assets, which doesn't typically happen in sovereign restructurings because they get solved quicker. And lastly, you know, you have the political situation in Venezuela. Like, how does the restructuring timeline interact with the local political timeline? You know, are there elections? Won't there be elections? So this is just the surface of what's going to happen here.
Absolutely. And the other huge wrinkle here is that U.S. economic sanctions remain in place. That has not been removed.
Right. I mean, it's illegal for them to actually restructure, to actually issue new debt as part of a restructuring. So this is just the very first step towards that, you know, investors have been building up since January.
Are bondholders ready to engage?
Oh, yeah. They have been ready. You know, there's been a bondholder group for years, and over the last couple of years, more and more firms have joined. We actually reported that they met, you know, with U.S. officials during the IMF spring meetings in April. They're ready. You know, if you ask the bullish investors, they'll tell you that this will all be done by the end of next year. Now, I don't know if that's the case, right? There's a lot more to think about.
Absolutely. So talk about some of the overall hurdles here that investors expect from the process. I mean, we mentioned the economic sanctions, we mentioned the political messiness of this whole thing, but any debt restructuring is difficult enough as it is without these extra factors thrown in.
Yeah, well, they have the court judgments, right? Like Venezuela has issues with Citgo, its U.S. refinery, and they're in the process of selling the assets after the court granted a judgment. How does that play into the restructuring? I mean, because it is probably the most valuable asset that the nation has, and other bond lawsuits here and there.
So the lawsuits, they always take a lot of time. That we know for sure. Bloomberg's Maria Elena Vizcaíno, she is our emerging markets reporter. Thank you so much. Still ahead, we've got our credit roundtable. Winnie Cisar of CreditSights will be joining us along with Barry Knapp over at Ironsides. This is Real Yield on Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. It is time now for the auction block, where we highlight the global credit issuance of the week. And we start with U.S. high-grade sales, which topped forecasts this week. Wells Fargo, ServiceNow, and Verizon, they were the top deals. ServiceNow attracted demand nearly 10 times the deal size, while Gilead's offering saw demand that was reportedly more than 9 times covered. Moving over to Europe, hyperscalers continued to raise funds. This time it was Amazon selling its first Swiss franc bonds across a record 6 tranches. The company raised $3.6 billion, and the offering size was increased several times. And speaking of hyperscalers, Alphabet has gone from Wall Street to Tokyo to raise funds. Overnight, it sold $3.6 billion in the biggest ever yen deal by a non-Japanese company. Recently, it has sold debt in euros, Canadian dollars, pounds, Swiss francs, and of course, US dollars. It is a 4-month run that ranks as one of the greatest corporate bond borrowing binges ever. Sticking with credit, some investors are pushing for more selectivity.
When you look at that full spectrum of yield, if you can get an attractive yield, stay relatively light in duration and very high in quality, on a relative basis, you're going to stay in that part of the market as opposed to an area where spreads are really tight and you're sacrificing liquidity. Are there wonderful opportunities to get above market yields where you're compensated for that risk? Yes, but you have to be very selective in terms of the sectors that you're exposed to and also just making sure you're getting paid for illiquidity and the risk premium.
Let's dig into all of this with our credit roundtable. Winnie Cisar is Global Head of Credit Strategy at CreditSights, and Barry Knapp, Director of Research and Chief Market Strategist at Ironsides. Let me start with you, Winnie. When we're going to stick with high quality here, what are the implications of higher rates? You know, with the 30-year hitting 5.12%, the 10-year yield now approaching 4.6% on investment grade.
Yeah, so higher rates have actually been perhaps counterintuitively a draw for higher quality investment grade investors. And we've seen reasonably strong demand for USIG really anytime it's above 5%. Given the move higher in rates today, we're actually seeing spreads that are somewhat stable, perhaps 1 to 2 basis points wider in USIG. Now, the flip side of that, of course, is the borrowing cost dynamic. And we all know that issuance has already been quite robust in USIG this year and is expected to remain so as we see continued hyperscaler capex and a wide range of other companies also leaning on the debt capital markets. And that is going to have pretty meaningful implications for borrowing costs if rates stay around current levels. The last thing I note is just from an all-in total return perspective, you are getting compensated pretty healthily to put cash to work further out the curve at this point.
Right. I mean, when it comes to demand, if rates go much higher, investment grade returns, at least year to date, will turn negative. And there's concern that retail investors, who are a big source of demand for IG, will react negatively. Barry, what happens if the Federal Reserve moves to hike interest rates?
Oh, I don't think that the Warsh Fed likely would. It would be a monstrous mistake, and it would do almost nothing to slow the rate of inflation. What they're more likely to do, certainly the Powell Fed wouldn't have done, but should have done, is to actually start shortening the duration of their SOMA portfolio. I've viewed for a long time policy to be roughly 50 to 75 basis points restrictive on the rate policy side, but 50 to 75 basis points accommodative on the balance sheet side. Even this week during the quarterly refunding, you know, the Fed was buying a significant amount of 3s, 10s, and 30s. So that downward rate pressure is actually allowing all the hyperscalers to borrow roughly 0.5 to 0.75% below where they would be otherwise. So what the Warsh Fed really should do, if they think that we're not going to resume core disinflation, I think we will, but if they decide we won't, would be to actually start reinvesting treasuries into shorter term securities and trying to tighten the balance sheet, not rate policy.
So, Winnie, let's bring it back to investment grade. Spreads are approaching levels last seen in January, which were the tightest in 28 years. And I wonder what could cause spreads to widen at this point. For those who are thinking that, you know, this is not sustainable, what changes that?
Yeah, I think that you have to have a really decisive move in a very meaningful way, either higher in base rates or lower in base rates. Our inclination is that spread widening would be much more consistent with Treasury yields gapping significantly lower. That would be indicative that something has perhaps gone awry in the broader U.S. economy and leaving the Fed a bit behind the curve in terms of easing policy, perhaps to support the labor market. Alternatively, if the 10-year Treasury all of a sudden gaps well above 5%, and expectations are that the Fed will be hiking rates with somewhat of an aggressive tightening bias, that could also drive some pretty significant spread widening, although the reality of just where dollar prices are for U.S. investment grade, that does kind of leave a lid on how much spread widening you can see in a rising rates environment.
So, Winnie, Alphabet, as we mentioned, has been on a global issuance spree. Almost half of its bond debt has been issued outside of the U.S. When you have these U.S. hyperscalers fanning out across the globe like this, what kind of disruptions do they cause for local companies who rely on their home markets for funding? I would imagine that this might be a threat.
Yeah, that's a really interesting nuance. And I would say that right now, there is still a tremendous amount of demand, especially in the primary markets. And oftentimes investors outside the U.S. welcome deals from U.S. companies because they're usually large, they're liquid, they're kind of well-known household issuers. And there is this kind of delicate balance of the crowding out effect, leaving local issuers a little bit on the sidelines. But I would say that most U.S. companies that are going into other markets, like all of the U.S. issuance that we've seen in the Euro market the past 18 plus months, are capitalizing on really just a widespread demand for new paper across a wide range of different company types.
And Barry, over to you. There's also what we're seeing right now is also different from previous multinational bond sales across multiple currencies, because in the past there were often these one-time financings tied to funding major acquisitions. But the AI build-out is very different, and this will not be a one-time thing. Hyperscalers will be tapping the bond market over and over again, including foreign currency markets. At what point do you think there might just be too many bonds?
Yeah. I think this is sort of my lens into how we think about when the AI boom, infrastructure build out is complete. And so there's a couple of metrics I'm watching closely. One would be CapEx to cash flow. In 2000, CapEx to cash flow for the telecom sector, all the baby bells and everybody else building out the infrastructure of the internet, got to 80%. And the build out of supply exceeded demand, and we had a credit event. The same thing happened in the energy sector in 2014, 2015. Right now, expected CapEx to cash flow for the communication services sector or a lot of these hyperscalers around 60%. But their underlying businesses are far more resilient, growing far faster than was the case with baby bells in 2000 or the energy sector, which is always, extremely volatile. So we have some distance to go. And you'd also expect to see at that point, when you start getting close to saturation, credit spreads start to widen, impacting the broader market. We had the biggest, Winnie can correct me if I'm wrong about this, but as far as I can tell, April was the biggest issuance month for IG credit ever. It's something I expected, and it didn't widen credit spreads significantly, other than there was a bit of a war going on. And so we really are some distance from that saturation point, 1999 or 2000 in the Dan Ives analog sort of scenario. So I think we have some ways to go.
Okay. Winnie, do you see evidence of borrower discipline emerging? Are enough of them, for instance, issuing equity to defend their credit ratings?
Yeah, I think that for the companies that realize they might be a little bit puspier in terms of rating agency action or even investor perception of what they're doing, there has been a lot of kind of proactive speaking to investors, trying to manage balance sheet policy. One thing that we're observing a lot, especially in the utility sector, which of course is key to the AI infrastructure, is a surge in hybrid issuance, which allows for some equity credit as well and has been very well received by the investor community. So I do think that companies are trying to take an approach that balances the reality of a need for a tremendous amount of new issue supply to fund the build out, and also trying to be a bit protective of ratings, especially in a higher yield environment where it really matters if you are a single A to triple B to double B borrower.
Barry, you mentioned telecoms back in the 90s. Our James Crombie has pointed out that spreads on investment-grade tech are now converging with spreads on telecom debt, which, of course, have long traded at wider spreads versus tech. What does that tell you about demand? Is there potentially some buyer's fatigue here showing up?
Well, I mean, we have a global fixed income demand problem. We've got unwinding of even far more aggressive balance sheet or rate suppression policies in Japan. The ECB was overly aggressive. The German debt brake is no more. The UK government is driving themselves into a ditch. We're running government spending at 23% of GDP. And global capital flows related to trade are getting restructured. When the biggest, bilateral trade imbalance was the U.S. to China, that money went into U.S. fixed income. That's no longer the case. So, you've got all sorts of disruptions here in terms of global fixed income demand. That's why we're seeing something of that real rate shock we're having this morning. I'm not particularly sanguine about the outlook for all that. Unless the U.S. gets its fiscal house in order and drives spending back to 20% of GDP, this problem is only going to be more acute. Right now, interest costs as a percent of GDP have been stable because the Trump administration slowed government spending growth from 11% in fiscal 24 to 3%. But, the outlook is still, pretty bleak.
All right, good stuff. On that note, we're going to wrap things up here. Winnie Cisar of CreditSights and Barry Knapp of Ironsides. Appreciate it. And if you can't get enough talk on credit, please check out the Bloomberg Credit Edge weekly podcast on the Bloomberg Terminal and wherever you get your podcasts. Still ahead, New York City Mayor Mamdani ditches his plan to raise property taxes in his latest budget proposal. We'll take a look at what he is now proposing in our Muni Moment next. This is Real Yield.
We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. First up, a global bond sell-off is gaining momentum, sending the 10-year Treasury yield to 4.58%, the highest level in nearly a year. Investors are worried central banks may need to keep rates higher for longer as oil prices rise amid the U.S.-Iran conflict. Brent crude hovering around $109 a barrel. Meanwhile, higher yields are pressuring stocks, with investors pulling back from riskier assets after a series of hot inflation reports. Even with today's decline, the S&P 500 is still on track for a 7th straight week of gains. Chip stocks are leading the sell-off today. Shares of Micron, Intel, and Nvidia are all lower as investors rotate out of some of this year's biggest winners amid rising rate concerns. And lastly, Boeing is falling after President Donald Trump suggested the company secured a China aircraft order during his visit, though key details remain unclear. Neither Boeing nor Chinese officials have provided additional context, leaving investors seeking details on the aircraft deal. President Trump also said China will buy around 400 to 450 General Electric engines. Those are your midday movers. I'm Nora Melinda.
It's time now for our Muni Moment. New York City Mayor Zohran Mamdani unveiled his $124 billion budget to help close the city's 2-year deficit. Lawmakers are now planning a new tax on homes purchased in cash for at least $1 million. We also get an update on U.S. higher education funding. So let's bring in Bloomberg reporters Laura Namias and Janet Lauren. We're going to start with Laura, who covers New York City and state. And I have lost track of the different taxes that have been proposed here. Just walk us through this new proposal.
Right. So we were able to report yesterday that the state of New York is planning to include in its budget a new tax on all cash purchases of residential real estate worth $1 million or more in New York City. This is not going to generate that much money, but this is in addition to the tax that we have already reported on, that you've heard about, probably the pied-à-terre tax,
right,
a tax on luxury second homes in New York City.
$1 million in cash. That sounds like a lot of homes in New York City.
It is. It is actually the majority of home purchases in New York for properties that are $1 million or more. 75% of the transactions in New York would be subject to this tax. That being said, it's not going to yield that much additional money. They're estimating $161 million a year, but it would affect the vast majority of properties.
Okay, right now this is still just a proposal, so it's not a done deal just yet.
Well, the legislative leaders are saying that it is going to be in the budget, which they haven't printed and voted on yet, but they are actively negotiating.
Okay, so when it comes to that pied-à-terre tax, the second home tax, is that expected to be permanent or is it a one-time thing?
It is expected to be permanent. However, the structure of it is going to change.
That's confusing.
It is very confusing, according to every party involved. Initially, co-ops and condos will be taxed one way, single-family homes will be taxed a different way, and then the state is putting the burden on the city of New York to come up with a new way to evaluate taxes on co-ops and condos, and then they'll all be taxed the same way in 2 years.
Okay, it's a bull market for our tax accountants. That's what it comes down to.
Absolutely.
All right, Laura, thank you so much. Laura Namias, who covers New York City and New York State politics and financing. And we're going to stick with munis and talk about higher education because MIT, the Massachusetts Institute of Technology, has responded to major declines in federal research funding. President Sally Kornbluth noted that campus research supported by government money is down by more than 20%. Janet Lauren has been covering this industry, and she joins us now with more. So exactly what is going on here at MIT?
So MIT is reporting that they're actually taking in less federal money than they had in the past. And what's concerning to them is that means they're funding less graduate students. And we're not talking about the business school. We're talking about students who are doing PhD programs and those types of students. And what's also concerning to MIT is this, we're talking about taxes, looming tax bill of the endowment tax that was passed last year. And it's hitting universities like MIT, Harvard, Stanford, to the tune of roughly potentially $300 million a year. So it's a lot of money, and this is something new. They've had a tax since 2017 of 1.4% of their net investment returns. And for the richest schools, $2 million of endowment per student, it's 8%.
And MIT is one of the richer schools?
Yes.
Okay, along with the Harvards and the Stanfords of the world. And by the way, you can check all of this out on Endo, E-N-D-O, Go, on the Bloomberg terminal. So how is MIT responding to all of this? What is it doing?
Well, they're doing a lot of lobbying, as the president mentioned in her letter. And they're trying to aggressively pursue other sources of funding, other potentially corporate partnerships. They're increasing enrollment in executive education, where their non-degree programs, students can come a couple of days and spend, $10,000. They're also increasing master's degree offerings. So they're looking for new sources of revenue. They also announced a couple of months ago they're closing libraries.
Wow.
So they're looking to tighten their belts.
Okay. I mentioned Harvard earlier. You also have a story out today about how much the university is paying its endowment CEO. What did we learn?
So it's roughly the same as last year, about $6 million in 2024. And if you add half a dozen of their top earners, it's about $25 million. So, as schools are belt tightening, it's just an interesting contrast. And Harvard's endowment has not been doing as well as it had been historically. It had been a leader. People would be envious of their returns. And lately, they've been sort of more in the middle towards the bottom.
Right. And of course, there's been a lot of turmoil in the ranks of Harvard's endowment as well, right? A lot of people coming and going.
Yes, certainly over the last 20 years, they've had a lot of people changing strategies. And then, of course, there's private equity to think about, which is not returning.
All right. Another story for another day. Janet Lauren and Bloomberg's Lauren Amias, thank you both so much. That was our Muni Moment. Now, still ahead, we've got the week ahead. We're going to get another read on the consumer with some big box retail earnings due out and results as well from NVIDIA. This is Bloomberg Real Yield. I'm Scarlett Fu, and this is Bloomberg Real Yield. It's time now for the final spread, which is the week ahead. Coming up on Monday, we get the G7 finance ministers and central banks meeting in Paris. They have a lot to discuss, especially with bond yields around the world surging. On Tuesday, Home Depot reports earnings, and the Google Annual Developer Conference takes place, as well as some congressional primaries in a couple of states. Then we get to Hump Day. On Wednesday, it's a make-or-break moment for the stock market, with NVIDIA reporting quarterly earnings that is the last of the Mag 7 names to report. Plus, the Federal Reserve releases minutes from its last meeting, and we get UK CPI. On Thursday, Walmart reports earnings, and we get more economic data, as well as Eurozone consumer confidence. Then we end things on Friday with University of Michigan consumer sentiment, UK consumer confidence, and Japan CPI. We already saw what Japan PPI did to bond yields today. For my final thought, I want to welcome back our Michael McKee, our international economics and policy correspondent. And Mike, you are zeroing in on the Fed minutes that's coming out next week.
Yeah, I also want to mention, who's not probably going to that G7 meeting? The new Fed chair, because Kevin Warsh hasn't been sworn in yet. But next week, he's been confirmed, but he will be chair next week. And next week he will face the Fed minutes. That's going to be the first release that comes out under his chairmanship. It will be the last meeting before he got there. But a lot of people, remember, dissented with the idea of the bias statement being towards another rate cut. And his job, according to the president, is to come in and deliver rate cuts. So we'll see what kind of opposition they expressed during that meeting, the members of the Open Market Committee, and whether anybody said, forget it, we're not cutting rates anytime soon.
And remind us, what was the vote for the statement in the last Fed meeting? I mean, how in sync or out of sync were the different voting members?
Well, it's a little bit odd because 11 voted for the statement, because they agreed with the idea of keeping monetary policy unchanged.
Okay.
But 3 of them dissented on the bias statement and wanted to change that language. And of course, Stephen Myron voted for a rate cut. But the 3 who did object, we'll see how many others objected who weren't necessarily voting members.
Okay, a lot to go through. And Stephen Meyer, an outgoing Fed governor, he no longer has a role, right?
He no longer has a role.
Gotcha. All right. Michael McKee, our international economics and policy correspondent. Of course, he will be with us all next week to break down all the economic data, including the Fed minutes. From New York, that does it from us. We continue to see bond yields stay elevated. The 30-year yield at 5.11%, the 10-year yield up 10 basis points at 4.58%.